Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and joining me this morning is Daniel Pan, Vice President at the Lakespire Group of Raymond James. Dan, it's great to have you on the show again.
You as well, Tai. Thanks for having me.
Today, I'm really excited about the topic we're going to talk about, which is how small business people should really start thinking about not just running their business, but a lot of sort of other complications or things that they might not have thought about, and they should.
Sure.
So, get us started on what folks should be thinking about.
Absolutely. Well, I'd like to say that wealth planning for a business owner is lots of the same things that we do for individuals and families, but you do have the added complexities that go along with it. And those complexities could be how to set up a benefit plan for your employees, which will be used to attract talent. How are you going to manage your cash flows? Even things along the lines of, for business owners that might be looking to pass their business on to their family or even just outright sell. Many complexities and many moving parts of that. So I like to generalize and just say that a business owner has the same issues that me and you would have and the families would have, but then they have many other layers of managing the business and managing their employees.
And I suppose the business owner who's working so hard, probably way more than 8 hours a day, probably maybe double that, and you're thinking about growing your business and making sure that I guess maybe your employees get paid and the customers are happy. Mostly some of these important things probably get shoved to the back burner, and you don't think about them, you don't look at them until probably something hits you in the face and say, oh shoot, I should have thought of that.
Yeah. We see it happen a lot. I would say with the Secure 2.0 Act, which comes down to governing employee benefit plans and whatnot, that was a major change. And business owners, it's a great thing because it offers them tax credits to set up plans, to cover some of the costs, and even some tax credits on their matching. But it's something that must be followed. So for the business owner who is doing everything last minute, it can either be last minute deadlines or even in worst case scenario it could be fines. So you're absolutely right. The business owner 9 times out of 10 focuses on their day-to-day managing their employees, but as advisors who work with business owners, our job is to keep them on track, keep them up to all the latest regulations, and make sure that they have plenty of time when they're making very big decisions.
So I know you brought some slides. I think I should bring up slide 1 or slide 2 at this stage.
Why don't we bring up slide 2?
Slide 2 would be great. I think it's on business planning.
Yeah.
So we have your succession and exit planning, working with investment banking, cash flow analysis, and business valuation. So you would just give us some ideas on some of those specific topics that, again, some of our viewers might have issues with and are not thinking about.
Sure. So coming back to your last point about doing things last minute and business owners putting their employees ahead of themselves, something that we really preach is for business owners who are looking to maybe sell the business to family, pass it along, or just outright exit. There are many pre-transaction planning strategies that can be used. These strategies can range from income tax mitigation, estate tax mitigation, and even capital gains. So for a business owner that is looking to sell and wants to reduce income tax, one of the solutions we offered is the incomplete gift non-grantor trust. And essentially what it is, it's setting up a trust in a no income tax or low income tax state where essentially you can reduce the income tax from the sale. Federal taxes must be paid. This is not an estate planning strategy, but if you're in a high income tax state such as California, New York, New Jersey, it's one of several potential strategies. I would go ahead.
Just to interrupt for a second.
Yeah.
Just give us just a rough idea. If you were a high income state versus a low or no income state, in terms of percentage points, how much are we talking about roughly?
Sure. Well, for people that are in the highest tax bracket, all in between state, local, federal, Medicare, you can be up in the 40s and 50s percent of total tax. If you are able to use some of these income tax strategies, again, in these high states, we could talk about potential 10% tax savings, and that's not tax deferral, that's true tax savings. So in the right situation, it makes a lot of sense. It just people need to consider that by doing certain trusts like these, you are giving up control of the assets to a certain extent. It's not for everybody, but it is for people in the right situation for sure.
That's a great point. I mean, you could lose a little control, but if you're saving 10% on something very substantial, it may certainly well be worth it.
Yeah.
But you had some other strategies. Sorry, I interrupted you.
Absolutely. No, absolutely. So, for people that are charitably inclined, the other pre-transaction planning you can do is all within the charity realm. So things like donor-advised funds, charitable remainder unit trusts, private family foundations. Essentially, what happens is the donor of the company stock, whatnot, can get an immediate tax write-off on the fair market value of the stock. Those proceeds can then be basically reinvested. They can grow tax-free and whatnot. Obviously, the remainder is going to go to charity. So if you're not charitably inclined, this is not something to do. But for someone who knew that they wanted to give to charity, this is a great way to do so, while also considerably saving on taxes.
Well, I think charitable donations are a pretty big deal for a lot of people. It's something well worth keeping in mind.
Yeah, absolutely. And donor-advised funds are something a little newer. They've been very popular lately because you can donate to this fund and you can actually still see it on your client statement. You can direct your donations at year end. It's a very elegant way to do so. Give you control. Yeah. One of my favorite techniques, it's very stringent criteria to meet but qualified small business stock is also a great pre-transaction planning technique to avoid capital gains tax. So essentially, for a business to qualify for qualified small business stock, the business has to have less than $50 million of total assets when the stock is issued. It must be a C corporation, and there are some other things, like it can't be in certain industries. So if your company is an accounting firm, a finance firm, other professional services, or even farming, you won't be able to qualify for qualified small business stock. But if it's a company in the technology or the manufacturing or retail space, it's possible that you could qualify for this. And what's great about qualified small business stock, or QSBS we call it, is that depending on when the stock was issued, the seller can basically exclude anywhere from 50% to 100% of the capital gains up to a cap of $10 million. So again, this is not tax deferral, this is true tax avoidance. So if we have younger entrepreneurs that are in the manufacturing, tech, or retail spaces, it's something we recommend they check out. Even if they have no plans on selling the business, this is something that must be done many years prior, and why wouldn't you want to at least explore that?
So you have to do this quite some time before you actually execute it?
Correct. QSBS must be held for a minimum of 5 years before it's sold. So this is not a last-minute type thing you do. This is some business owner that realizes that they do have a succession plan, but it's not anytime soon. It's something something they should explore.
So it sounds as if it allows you to move a chunk of up to $10 million or thereabouts at a lower than a market rate. So you save potentially a lot on capital gains.
Correct. You're not really moving it, but essentially it's an incentive for people to create companies. So basically, by getting this QSBS status, the government says that we will exclude the first 50 to 100% of the capital gains. We'll exclude that from taxes. It's really to incentivize people to start businesses.
Interesting. And I mean, I'd never heard of it. I'm not really a small business person myself, more on the finance side, but it sounds like a really valuable tool if you know about it. I don't know how well advertised this is.
It's not, and probably just because it's for a very small subset of the companies out there. But tech is very big, right? I mean, technology companies are always being founded. So again, it's a box that you should check. It's something that you should explore if you're in that criteria range.
Wow. I mean, I live in a town that's really kind of a lot of entrepreneurs in that town,
sure.
and I'm at dollars to donuts, and I bet a lot of people have never heard of this. So it sounds as if you should be working with consultants, financial consultants like Lakespire for, well before you're thinking about selling your business or moving on from your business.
Sure.
I mean, a lot of savings.
Yeah, and again, anything that's you put your time into it, you think it through. We believe the outcomes will be better. Getting back to the qualified small business stock, it is expensive to set up. I mean, you're going to have to hire a lawyer. So, there's always that possibility that you go through, you spend the time, you spend the money to get it set up, and then for whatever reason, if the business fails, maybe it didn't work out. But, again, it's still worth exploring, we believe.
Yeah, I certainly want to have this on the menu,
absolutely.
so to speak.
Absolutely.
Yep.
Absolutely.
And in terms of some of the other, this is planning that I don't think a lot of business owners are really thinking about. So in terms of some of the other I think one thing that you mentioned earlier, it's a good time to talk about employee benefits.
Sure, absolutely.
And I think it's slide 3. If we could bring up slide 3, I think the employee benefits. So, tell us a little bit about some of these benefits and when businesses really start to need to be concerned about them. Is it when they get from more than 3 employees, more than 5 employees? Or at what level should they really start thinking about this?
That's a great question, and I would say that they should start thinking about it from day one. Maybe as long as there's company revenue, but we've helped single member LLCs form cash balance plans. So it could be one individual running a company, maybe doesn't have any employees, but it's a high cash flowing company, and if that individual is looking to put large amounts away pre-tax, there are more complicated solutions that will allow them to put away more than the traditional 401k limits, right? But I would say that with Secure 2.0 Act, any business owner with 10 or more employees really has to be addressing these because A, it's a great way to retain talent. It's a great way to make your employees feel wanted, feel motivated. But B, it's mandated now with Secure 2.0.
Can you tell us a little bit more about Secure 2.0?
Yeah. So Secure 2.0 Act, it's relatively new. It's been around for a few years now, and essentially, this is a way for employees of smaller businesses to make sure that they're getting the same type of benefits that someone that works at a Fortune 500 company might get. So Secure 2.0, again, it mandates any business with 10 or more employees must offer some type of corporate retirement plan.
Wow.
And even to make things easier for the business owner, as I mentioned, they will offer tax credits for plan startup costs up to a certain amount. They will potentially offer tax credits for employee matches. So, government realizes that Americans need to save, and this is a great way to do so. And even Secure 2.0 has also made it easier for Roth contributions. Because years and years ago, most 401k plans only had the ability to give money pre-tax, but now the Roth component of a 401k is getting very popular. So younger people might see a Roth 401k as a better alternative to a traditional pre-tax 401k.
Let's get into Roth a little bit, because I have my oldest kids is out of college, and she was asking about this. So a Roth is you put after-tax money in. So am I right to say that it makes sense if you're not in a very high tax bracket right now, to eat the taxes now and then let it grow, and then you can take it out tax-free later? Is that how the Roth works?
Correct. You hit the nail on the head. The Roth, we believe it's a fit for many people, but especially for younger individuals who are in lower tax brackets. They might be putting after-tax dollars in that are at a blended tax rate of, say, 20 to 25%, whereas a C-level executive who's in the top tax bracket, it's going to, the cash flow, he's going to feel it a little more because he's losing that pre-tax benefit at the higher tax bracket.
Is there a contribution limit annually on Roth IRAs?
I believe it's $7,000 currently. However, if one was to use the Roth 401k component, the limits are a little bit higher.
Oh, so, what's that? It's a combination of a Roth and a 401k?
Yeah, so it depends, because there are different types of plans, but most of the time when you have a Roth 401k, the Roth is one component of the overall 401k. So if the company makes a match, the company will always match with the pre-tax dollars, whereas the individual can put his or her money into the Roth component. And frankly, a lot of people are doing a little of both. So I've seen clients that might do 50% of their monthly contributions into the pre-tax bucket, 50% into the post-tax bucket.
Oh, that makes a lot of sense. Sort of like a bucket for both things, and then makes sense that the company will want to do it pre-tax, and then if you put up to $7,000 and your tax bracket's pretty low now, maybe you'll retire wealthy and it'll be sort of higher later. And it seems that over time taxes really only go up, except for the blessed Ronald Reagan.
This is true.
Right?
This is true.
It makes a lot of sense, and my kids were asking about it, so that's useful to really think about. I didn't really know that there was actually a Roth 401k.
It's much more popular now than it was. Again, maybe 10 or 15 years ago, 5 to 10% of plans had it, but now it's starting to become the majority, actually. And one thing I'd also mention about the Roth is when you're looking at your overall asset allocation, right, whether you're an aggressive investor or a conservative investor, we typically recommend putting the more aggressive assets into the Roth, right? Whatever assets you think are going to be the higher growth assets, because again, all the growth going forward is tax-free. So let's just say, if you have your fixed income allocation here, your growth equity allocation here, we believe that it would make sense to put the growth equity component into the Roth and the fixed income, the lower return vehicles, into the pre-tax bucket.
Right.
Kind of to maximize the tax-free growth.
Right. Makes sense, right? Because you've already paid the taxes, you'll never owe it again unless there's legislation to do so. I suppose that's possible, which will, if it ever happens, would be highly unpopular.
Yeah.
And as they say, old people vote.
Yeah.
So hopefully we won't have to worry about that.
Yeah.
Now, in terms of health plans, I guess health plans do you help business owners decide on what health plans to choose? Because we work for big companies. I've worked for big companies, and you sort of take that for granted. But for a small business, that could be a substantial investment, substantial cost.
Sure. So we don't actually. We don't advise on the actual health plan itself. That's more of a kind of a benefits or insurance broker.
Okay.
But we do have networks, and we do have people that we can refer to. So that's not something that my firm or I do. But if we're working with a business owner that's in need, we definitely have avenues to refer him or her. But
go ahead.
One thing I would say is that HSAs are kind of a subcomponent of that. So a health savings account basically allows the individual to put pre-tax dollars into an account that can then be used for healthcare expenses. So for someone who, they know that they're going to have just a lot of expenses in a year, it's a good way to kind of fund that with pre-tax dollars. So that's something else we recommend.
I want to shift a little bit. For the business owners who might be looking to utilize investment banking services, can you talk a little bit about deal volumes compared to today where they were before, and how a firm like Raymond James could help them get into a little more sophisticated on the finance side?
Sure. So investment banking deal volumes, especially in the equity space, are down significantly from their 2021 peak. Most of that, I would say, is due to just higher interest rates, but we've had economic uncertainties, political uncertainties. So, investment banking deals are down. We're hopeful that that'll change in 2025. If the Fed sticks with its path of lower interest rates, that in itself will be a good catalyst for these deals. Raymond James is a top middle market bank, and we have the ability for our clients to actually refer them to the Raymond James Investment Bank, whether that business owner is looking for growth capital, wants to take the business to a next level, or if they're potentially looking to sell. If it fits our criteria and the investors that we work with, we can actually, the Raymond James can actually help with that business. Raymond James bankers, they've got excellent networks in the private equity and venture capital space. So they do a great job of pairing business owners with sources of capital or potential buyers.
That seems to be pretty important, because if you're a business owner, you're worrying about your business, but if you're looking for some additional funding, you want to work with somebody reputable, or if you're looking for funding or some kind of, I suppose, a sale. Yep. Is there a sweet spot in terms of how big the business is for the clients that you've worked with? Is it something like $5 to $50 million, kind of a sweet spot where you paired up clients with the investment banking services of Raymond James?
Great question. I would say it's more middle market focused.
Okay.
So companies that have a few $1 million of revenue, that might not be a fit for us, but we do have a network of external investment bankers, smaller firms that can accommodate, and also very large corporations, publicly traded companies. We can help as well. But I'd say Raymond James, we're probably anywhere from maybe 10 to 50 million of EBITDA, and goes the gamut of industries. We have a very good healthcare investment banking franchise. We've been doing lots of activity in the real estate space. So I think that's our sweet spot in the middle market.
Right. And then companies that are sort of big enough that that they need that help, but then it's good that you have partners that you could probably recommend for people at an earlier level, like that need kind of special hand holding and maybe sort of specialty knowledge.
Yeah. And that's why it's great for the company looking to take it to the next level. It's great to pair them with more of a strategic type buyer, right? A private equity firm that's got deep knowledge in whatever industry that business is in, that can help them scale, help them take it to the next level. So that's the name of the game for us, is making sure we find the best fit for that business owner and whatever his or her goals are.
Now, some of the things I guess I'd like to talk about when we were chatting before the show. We bring up slide 4, and what are some of the risks that are unique to business owners?
Great question. So, outside of the business itself, which the business owner knows his or her business, so outside of that, some of the risks that the business owner might come across is, say, key person insurance. So key person insurance provides a monetary payout if someone, like your number one salesperson, your rainmaker, if they are disabled or can no longer work, or even the CEO, because with someone like that, it's going to be cost to find someone new to replace, to train, and for your best salespeople, that could be lost revenue, it could be lost clients. So key person insurance can provide a monetary payout to offset some of that lost revenue, some of the costs. So that helps a lot. And then I would say, for businesses that maybe have multiple owners, a buy-sell agreement is also another solution that we like, because with a buy-sell agreement, it's something that you do well before you're looking to sell the business, but it provides a kind of standardized method to value the business. It's a kind of a pre-arrangement on how are we going to go ahead and sell it. And then also, if the person that passes, if the other partner is looking to buy it, they might not have enough capital to buy the partner out. So this buy-sell agreement can also help, actually the buyer can provide them a payment to help them actually purchase the other share of the business. So in the right situations, those make a lot of sense. And then I would say, just making sure that the business is insured properly, making sure that your P&C insurance levels are proper, making sure that you're offering all the disability and life insurance to your employees. That's very important as well. And and then again, we use life insurance as well, right? I mean, because key person insurance is a form of life insurance, but again, life insurance is also a good risk management tool that we use for anybody.
Is key person insurance for small businesses common?
It's a great question. I would say probably not as common for smaller businesses, but for the businesses that identify the risks and really think things through, it's something that makes a lot of sense. But probably more common for your middle market companies, companies with lots of employees.
I asked because I invested in a sort of a family, decent-sized family business, okay. And you always think, if the investment is really on the CEO. If the CEO, decides to leave or has an unfortunate something happen to him, then you're for my investment, I'd actually like to take key person insurance out on that CEO. I suppose that probably, I'm not sure an insurance company might want to sell that, but it seems like it's a good idea in certain specific cases where someone is so important that you want some kind of compensation, or at least to bridge you over a gap.
Sure. Yeah. I think that's what you'd have to do. You'd have to kind of go through your employees and the owners and try to quantify what would happen if this person or that person got sick, became incapacitated, or even passed away. What kind of financial hardship would occur? And if you're able to think it through, try to quantify that, that's probably the first step of considering key person. If the loss is going to be on the smaller side, there's enough cash flow on hand to cover it, it might not make sense. But if there's a major rainmaker out there that has the ability to also poach some of your clients, and it would lead to much larger revenue losses, that could be a good situation for it.
In terms of risk, succession planning, as businesses get a little more mature, maybe the CEO is looking to retire and looking to either, if it's a family business, moving it on to their families, do you help out with sort of succession planning?
Sure, absolutely. I'm just gonna let's go back to Yeah. So succession planning is huge. There's many different types of estate planning strategies that can, essentially help the business owner pass more of the business on to either their heirs or even, to themselves. So, like using something like an illiquidity discount or a minority control discount will allow a business owner to kind of get more of those shares out of their estate. So essentially, what an illiquidity discount is when there is not a readily available market or a readily available way to value a business. You can take a discount. So, Apple or Microsoft, you can find out wherever that's trading in a millisecond by looking it up. A smaller private company, the value of it is a little harder to determine. It'll get determined upon sale, but before that, it's more of a range. So if someone was to use an illiquidity discount, if they believed in their heart that, let's just say, the company was worth $50 million, you might be able to say, well, because it's not readily available to sale, because the shares are illiquid, we can treat it like it's worth less. Or maybe it's worth $25 million or something along those lines. So the business owner can now take more of those shares and get them out of his or her estate, right? Because if the exclusion, let's just say, is $13.5 million, and let's say without the discount, maybe you can get 10,000 shares out of your estate. If you use an illiquidity discount, you could potentially get maybe 20,000 shares out of your estate without using the exclusion of them.
That sounds like it could be pretty important, and it makes sense, right? If you're price discovery, Apple and Microsoft, you know exactly where they're trading. Sure. But a family firm or a firm with 20 million in EBITDA, 10 or 20 million in EBITDA, and you're not publicly traded. Mm-hmm. If you said, well, I want to sell this, and somebody says, well, you want my bid, the bid's actually really going to be much lower. So Sure. It actually, economically, it makes sense, and it sounds like it's really important to take advantage of something like Sure. this illiquidity discount.
Sure. And then, then there's, getting back to succession planning, there's kind of the non-numbers element, more the human element, right? And that could be bringing the whole family together, right? So as the owner is doing the planning, it's bringing the family together, making sure that everyone's on the same page. Because, for all the owner knows is his or her children might not want to take the business over at all. So he or she might have been thinking the whole time that, Tommy and Jane is going to take the business over, when they turn 60. Needless to say, Tommy and Jane might have zero interest. So we think that the succession planning is really, the human element is very important because, it brings families together. The more communication, the better. And ultimately, the more planning you do, typically the better the outcome.
And you certainly, I guess, help with that in terms of being the consultant for the owner.
Sure.
And you bring them together. And that
Sure.
makes sense. I mean, I was just reading about the Murdochs and how he's trying to fiddle with his his succession.
Just this morning.
It hasn't quite worked out the way that he's wanted it to, and that's on a very, very large scale. But I could see in a family business, you definitely want to get that sorted out.
Sure.
for business reasons as well as family and personal reasons. You don't want that to go sour.
Sure. Yeah. And while Raymond James, we don't actually draft the legal documents. We have our in-house planners that they can basically help advise, and then when the time is ready, we will refer out to a trust and estate and law firm for the actual drafting of the documents. But we feel that we can offer unbiased research and recommendations that are always in the best interest of the owner and the family. And again, the more communication, the better.
That's great. Well, thank you so much for coming on the show today and giving us a sort of a primer on, if you're a small, medium-sized business, how you ought to actually be planning the whole way before you want to do something. Maybe there's 5 or 10 years of planning in advance.
Absolutely.
So looking forward to having you again on the show soon.
Thank you very much, Ty. I enjoyed it and I look forward to it.
Thank you. And that will do it for Global Money Talk, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sompro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thanks so much for joining us. We'll be back here tomorrow. Have a great day.